In 1781, a British ship captain was sailing from West Africa to Jamaica with over 400 people in the hold. The ship had run low on water after a series of navigational errors. The captain did the math. If those people died of disease during the voyage, the ship's owners would not be compensated. But if they were thrown overboard, treated as cargo jettisoned for the safety of the vessel, there was an insurance claim that could be filed. He ordered the crew to throw more than 130 living people into the ocean. Then the owners filed their claim, and a London court initially ruled in their favor. Okay, that story is not where insurance begins. It is where the logic of insurance reaches its most horrifying conclusion. To understand why an insurance policy could make that calculation possible, you have to go back to the beginning. Not the 1700s, not the 1400s. You have to go back to ancient Babylon, about 3,700 years ago, because insurance is not a modern invention. It is not a corporate product. It is not something a financial services company dreamed up to extract money from you. It is one of the oldest financial mechanisms human beings ever built, and it has been running in one form or another ever since. Around 1750 before Christ, a Babylonian king named Hammurabi codified a set of laws that governed commercial life across his empire. One of those laws dealt with what they called a bottomry contract. Yeah, it sounds strange. Here's what it was. A merchant needed money to fund a trading voyage, to buy cargo, load a ship, send it down the river or across the sea. A lender would give him that money as a loan. The catch was the interest rate. Hammurabi's code set it at 20%, an extraordinary rate even by ancient standards. But the reason for the rate was written directly into the contract. If the voyage succeeded, the merchant paid back the loan plus 20%. If the ship sank, if the cargo was lost to pirates or storms, the loan was forgiven entirely. The lender absorbed the loss. That 20% was not greed, it was the price of the risk. It was the world's first insurance premium bundled into a loan. And those Babylonian merchants were not alone. Around the same period, Chinese traders navigating treacherous river rapids had already worked out that if you spread your cargo across many boats, a single capsizing does not ruin you. No contracts, no premiums, just the plain arithmetic of survival. You are safer in a pool than alone. The same logic crossed into the ancient Mediterranean. Greek merchants built it into their maritime loan agreements. The island of Rhodes developed a law of the sea that said if cargo had to be thrown overboard to save a ship, every merchant on that voyage contributed proportionally to the loss. If you benefited from the ship surviving, you shared the cost of its survival. That principle became so foundational that it was absorbed into Roman law, and it survives in modern maritime law today. But Rome took the concept somewhere new. A Roman general named Gaius Marius, about 100 years before Christ, organized his soldiers into what historians call burial clubs. Each soldier paid a small amount into a shared fund. When any member died, the fund covered the funeral. If you outlived your comrades, you contributed to their burial. Simple, direct. Think about who was participating in this. Not merchants, not wealthy traders protecting cargo. Soldiers. And below them, the actual bottom of Roman society. Slaves and freedmen who formed their own burial clubs. They had nothing. No property, no rights, no savings, but they paid monthly dues into a communal fund. Because the one thing every human being needs, a burial, was something they could collectively guarantee each other. The most stratified empire in the ancient world had invented mutual insurance among its poorest people 4,000 years before anyone called it that. Then the Roman Empire collapsed, and for about 800 years, formal risk transfer mostly disappeared from Western Europe. The Catholic Church had something to do with that. The church condemned usury, charging interest on loans, as a sin. Anything that looked like extracting profit from time or from another person's need was morally suspect, and insurance looked a lot like usury. You pay me a fee, I profit if your ship sails safely, I pay out if it sinks. Was that a loan? A gamble? The church was not sure, and it was not inclined to resolve the ambiguity in favor of the merchants, so for centuries, insurance was illegal to write openly. And the merchants did what merchants always do when a financial tool they need is declared illegal. They disguised it. First they wrote insurance as fictitious sea loans, contracts that looked like loans, but were secretly pure risk transfers. Then they wrote it as fictitious sale contracts. The legal fiction shifted as the church's lawyers got more sophisticated, and so did the merchants' lawyers. All right, and this matters because it was this very constraint, the need to disguise insurance as something else, that forced medieval merchants to think more carefully than anyone before them about what insurance actually was, what risk was being transferred, under what conditions should a claim pay, what counted as a genuine loss versus fraud. Then, in October of 1347, in the port of Genoa, a notary wrote a contract that was just insurance. No disguise, no fictitious loan, pure risk transfer. A merchant paid a premium. If the cargo arrived safely, the underwriter kept the money. If the cargo was lost at sea, the underwriter paid. The loan was gone. The fiction was gone. That contract, historians believe, is the first pure insurance contract ever written. It is older than the printing press. It is older than Columbus reaching the Americas. What is extraordinary about the medieval Italian insurance markets is how quickly they figured out the math. By the late 1300s, insurers in Venice, Florence, and Genoa were pricing marine insurance at roughly 3 to 4% of the cargo value for a standard Mediterranean voyage. They charged more for routes with piracy risk, more for winter voyages, more for ships with uncertain captains. They were pricing risk without probability theory, without actuarial tables, without computers, just pattern recognition, reputation networks, and enough data to see that some voyages sank more than others. That's crazy. Okay, and Barcelona became the first city in history to regulate insurance markets, issuing 5 insurance ordinances between 1435 and 1484. The world had insurance law before it had a single printed book. On September 2nd, 1666, a fire started in a bakery on Pudding Lane in London. It burned for 4 days. When it was finally contained, 13,200 houses had been destroyed, 87 churches, the Royal Exchange, St. Paul's Cathedral. The entire commercial heart of the city was rubble. The estimated cost £10 million at a time when London's entire annual income was £12,000. Every family who lost a house lost everything. There was no mechanism to recover, no institution to help. The concept of rebuilding after a catastrophe of that scale simply did not exist. A physician and economist named Nicholas Barbin had been watching. He had been collecting statistics on London buildings and fire incidents since the fire, and now he had a calculation. If enough property owners each paid a small annual fee into a shared fund, the fund could absorb any individual loss, no matter how large. The pool, if it was big enough, could survive anything. In 1680, Barbin founded the Fire Office, the first joint stock fire insurance company in the world. The pricing was explicitly risk-based. A timber building cost 5% of its annual rent to insure. A brick building cost 2.5%. Higher risk, higher price. The mechanism was the same one Hammurabi had codified 3,000 years earlier. Barbin also did something no one had done before. He hired firefighters, not public servants, private employees of the insurance company, mostly Thames watermen, strong men who knew the river, trained to fight fires in insured buildings. He gave them uniforms and equipment, and he invented fire marks, lead plaques stamped with the company's emblem, bolted high on the outside walls of insured properties. When a fire broke out, the brigades raced to the scene. The fire mark told them which company was liable. Their job was to save the building before the claim had to be paid. Yeah, the world's first professional firefighters were insurance company employees, not a public service, a financial product. All right, 6 years after Barban opened the fire office, a man named Edward Lloyd opened a coffee house on Tower Street in London. He did not underwrite insurance himself. He ran a tavern, but he understood what his customers needed. Lloyd's customers were sailors, merchants, and ship owners. They needed information, weather reports, ship movements, the reputations of captains, the reliability of routes. Lloyd built a network of correspondents at ports across Britain and Europe who reported that information back to his establishment. He had a pulpit installed in the newer premises when he moved to Lombard Street, from which maritime news was read aloud to the room. And the wealthy men who gathered there, men with enough capital to absorb a significant loss, began a practice that would define the English insurance market for centuries. Each would read a policy description, a ship, its cargo, its route, its captain, and if he was willing to accept a share of the risk, he would write his name and the percentage he would cover underneath the policy. Underwriter. By the 1700s, Lloyd's Coffee House was the nerve center of global maritime commerce. The most complex risks in the world, whaling voyages to the Arctic, East India Company cargo, naval supply contracts, were priced and covered in a single room by a group of men drinking coffee and reading shipping news. Yeah. In 1773, the underwriters formalized into a society and moved to the Royal Exchange. The coffee house was gone, but the institution it had built would survive for another 2.5 centuries. Okay, enslaved Africans on transatlantic slave ships were written into insurance policies as cargo, not as people, as items with a monetary value that could be protected against loss. Historians estimate that by the 1780s, slavery-related business, slave ships, slave-grown commodity cargo, slave work plantations accounted for somewhere between 1/3 and 40% of Lloyd's total premium income. That is the financial context for what happened in 1781. The Zong was a slave ship owned by a Liverpool syndicate called the Gregson Firm. It had left West Africa in August with 442 enslaved people aboard, more than twice its safe capacity. The captain, Luke Collingwood, made navigational errors that left the ship hundreds of miles off course, running short of water and food. He made a calculation. Under the terms of the policy, enslaved Africans who died of disease during the Middle Passage were the owner's financial loss, not insured. But enslaved Africans thrown overboard as an emergency measure to preserve the ship could potentially be claimed as cargo jettisoned for the safety of the vessel, a compensable maritime loss. Between the 29th of November and the 1st of December, 1781, Collingwood ordered the crew to throw more than 130 living people into the Atlantic Ocean. The owners filed a claim. The first court found for the owners. The insurance company appealed. During the appeal, an abolitionist named Granville Sharp learned of the case and made it public. And formerly enslaved man named Olaudah Equiano brought Sharp the initial details. The case became a turning point in the British abolition movement. A British judge was being asked in the most public possible forum, were these people cargo? Were their deaths a business loss? Was insurance the appropriate instrument for accounting for their murder. In 1791, Parliament passed a law prohibiting insurance companies from compensating ship owners for enslaved Africans thrown overboard. The legal mechanism that had made the Zong's math rational was closed within a decade, but the Zong case had already done something more important. It had put the question in the open. If a financial system says these lives are worth only their insurance value, what does that say about the financial system? What does it say about who is inside the pool and who is outside it? The Slave Trade Act followed in 1807, 12 years before the Zong Massacre in 1762. A man named Edward Rowe Morris opened a new kind of insurance company in London. He called it the Equitable Life Assurance Society. It was built on work that a mathematician named James Dodson had spent years developing after being rejected for life insurance by the Amicable Society because he was too old. All right, so Dodson's insight was this: the price of life insurance should not be flat. An older person is more likely to die in any given year than a younger person, and therefore more likely to file a claim. If you charge everyone the same premium, the young subsidize the old and the healthy subsidize the sick until only sick old people are buying the product and the pool collapses. What you needed was mortality tables, statistical records of how many people at each age die in a given year. In 1693, the astronomer Edmund Halley, the same man the comet is named after, had published the first scientifically grounded mortality table based on population records from the city of Breslau in what is now Poland. He had even shown how to use it to price life annuities, but no one had built an insurance company around his math. Morris did. The Equitable Life priced premiums based on age. Younger members paid less, older members paid more. The company's reserves were calculated actuarially, not by guesswork, but by mathematics. Morris coined the word actuary for the person doing that work, borrowing it from a Latin term for a record keeper, specifically to distinguish the role from gambling or speculation. For the first time in history, a life insurance company's premiums were set by science. The risk was quantified, not estimated. The pool was stable because the math was sound. This was a genuine revolution. In the century that followed, life insurance became a major industry on both sides of the Atlantic. It protected families against the catastrophic financial consequences of a breadwinner's death. It funded mortgages and long-term investments. It created a savings mechanism that benefited ordinary people in ways the wealthy had never needed. And then almost immediately, the industry found ways to use that same actuarial precision to exclude the people who needed it most. Okay, by the 1890s, most American life insurance companies had stopped serving black customers entirely. By 1940, more than 40% of U.S. life insurance companies did not accept black policyholders at all. Those that did charged higher premiums. The actuarial justification was real. Black Americans in the 19th and 20th centuries had higher mortality rates than white Americans. The data was accurate. What the data captured was the financial consequence of discrimination itself. Worse medical care, worse housing, worse nutrition, economic exclusion, racial violence. The higher mortality rate was the product of a system that had already decided black lives were worth less. And then insurance companies used that mortality rate to reinforce the conclusion. The same thing happened in property insurance. Homeowners insurance was denied in black neighborhoods through redlining maps, government-coded designations of which neighborhoods were safe investments. Without insurance, you could not get a mortgage. Without a mortgage, you could not own a home. Without a home, you could not build the generational wealth that white families were accumulating through insured property. The pool had been drawn around race. Meanwhile, in 1884, an unlikely figure made the most significant expansion of insurance in history. Yeah, Otto von Bismarck, the Iron Chancellor of Germany, was not a progressive. He was a conservative aristocrat who despised socialism and worker organizing with equal intensity. But he watched the socialist movement growing in Germany's industrial cities, and he understood something that his opponents on both sides did not. The reason workers were attracted to socialism was that they had no protection against the catastrophic risks of industrial life, injury, illness, old age, unemployment. They had no pool. When disaster struck, they were on their own. So Bismarck gave them a pool. In 1884, he created the world's first national workers' accident insurance system. In 1883, national health insurance. In 1889, old age and disability insurance. The world's first welfare state was built explicitly as a political counter to socialism. Give workers a financial stake in the existing order, and they will not need to overthrow it. The principle was the same as Hammurabi's bottomry, as Rome's burial clubs, as Bourbon's fire office. You are safer in a pool than alone. The only difference was scale. For the first time in history, the entire nation was the pool. Every social insurance system in the modern world, Social Security, Medicare, workers' compensation, unemployment insurance, follows this same template. Bismarck invented the modern welfare state not out of compassion for workers, but out of fear of what workers would do without it. Okay, today, the global insurance market generates roughly $7 trillion in annual premiums. The United States alone accounts for more than $3 trillion, roughly the size of the entire German economy. Insurance is not a financial services industry. It is the infrastructure of the modern economy. Without insurance, mortgage lenders will not finance property. Without insurance, ships do not sail and planes do not fly. Without insurance, hospitals cannot operate under the liability of modern medicine. The entire structure of investment, trade, property, and healthcare sits on top of insurance as its foundation, a foundation most people never think about until it fails, and it can fail. In 2008, a company called AIG, at the time the largest insurance company in the world by assets, required a $180 billion federal bailout. But what failed at AIG was not actually insurance. AIG's insurance subsidiaries were solvent. What failed was a derivatives trading division that had used the insurance company's credit rating to sell hundreds of billions of dollars of contracts on mortgage-backed securities, contracts that paid out if the housing market collapsed. The housing market collapsed. AIG could not honor the contracts. The mechanisms that the derivatives traders used were the same mechanisms as insurance, risk transfer, pooling of exposure, premium collection, but the risks were correlated, not independent. When the housing market failed, everything failed at once. The pool could not absorb it. The ancient rule violated in 2008. Insurance only works when not everyone is exposed to the same catastrophe simultaneously. Check this out. That exact crisis is happening right now in California. All right, major insurance companies have stopped writing new homeowner policies in wildfire zones. Some have stopped renewing existing ones. The proximate cause is climate change. Wildfires are burning larger, more frequently, closer to populated areas. But the deeper cause is the same one that has governed insurance since Babylon. When risk becomes too concentrated and too certain, the pool cannot work. You cannot insure everyone in a flood zone when the flood is now every year. You cannot insure a house in a wildfire corridor when the fire is now a question of when, not if. When insurance withdraws from a region, property values collapse. Mortgages become impossible to get. the wealth that generations of families built in those neighborhoods disappears. Not because they did anything wrong, because the pool that was protecting them stopped being large enough to function. The mechanism Hammurabi described nearly 4,000 years ago is breaking in real time in California. The same mechanism that Roman soldiers used to guarantee each other a burial, that Genoese merchants disguised as loan contracts to smuggle past the church's prohibition, that a London physician built out of fire statistics and Thames watermen. You are safer in a pool than alone. That is the entire logic of insurance. The question that every civilization has answered differently, and the question that is still being answered now, is who gets to be in the pool? When you pay your premium every month, you are participating in the oldest financial agreement in human history, an agreement that says, I will put something into the pot because the pot protects all of us. The deal has worked for 4,000 years. The only thing that has ever changed is who we decided was worth protecting. If this kind of history is new to you, stick around. There is a lot more where this came from.